Good evening and welcome to this Shadow Short. My name is Peter Reznicek from the Weekly Options Room at ShadowTrader.net, and I'm here to talk to you about the broad market ahead of the Fed and also, more importantly, post my weekend edition video, which was called The Market Just Topped, and I recorded that on Friday where the market had closed right in here. This was Friday, and obviously the market didn't top since then. We have now printed these two candles up here. So the question is, what am I doing, and has the thesis changed, and how am I going to be managing this going forward? So first, let's talk about the thesis here. I don't think the thesis has changed because we haven't had any major expansion of range outside of Friday. There was actually basically just a gap and hold on Thursday. This is called a gap and hold. It went up a little bit. And then today was a gap up and fail where we fell down quite a bit. And all of this price action has us still sitting right here on the outside of the channel, which to me is a little bit bearish and overextended. And little by little, we have had some catch up being played, so to speak, of the 8, but as I talked about in the video, I think it's still relatively overextended from the 8. And regardless of whether you believe it's overextended or not, the fact of the matter is that markets will trade on both sides of the 8 like this, and this is what I'm expecting. My main kind of overall thesis is simply that the 0.25 rate cut is baked in, and there is no catalyst for the market to rally further on that unless it gets the 0.50, which I do not believe it is going to do. I don't think that Powell is going to go there. But that I believe the market would construe as bullish. But the general run-of-the-mill rate cut, which is what we're going to get of the quarter point, I think the market will price in that, or the market will rather tell us that it is already priced in and should come off somewhat. All right, so what's my position now and how am I going to manage ahead of the Fed where we know anything can happen? So currently, right now, I am here, which is short just a few thousand SPY, not overly big. I would like to increase this position, but only on weakness, only if I get some sort of confirmation that things are getting weaker, and maybe bring this up to 5,000, okay? Now, how am I going to protect myself if the market goes up? Well, in order for that, we need the options market. And so I want you to look at this on the Analyze tab. Tomorrow, when we get to the Fed, the at-the-money calls that are DTE 0, which as you can see would be this one right here, I believe they're going to trade somewhere in the probably $1.50 range or even less. It depends. I look at these a lot on the Fed. Sometimes it makes sense to do a straddle, whatever, regardless. But the 660 call is not going to protect me all the way because as I was saying before, my basis is a little bit lower, but it'll totally mitigate a huge loss if we get a big move up. And look at these puts right here that are $10 less, these 650 puts. These are going out to Friday, and they can be sold for $1.43. And my goal is that tomorrow, at some point, these are either going to be equal in price, which means that I will have zero debit, and I will have no upside risk past 660, right? And obviously, these strikes may change because we may be up or down, and if the market's down heavy tomorrow, I may not need to do this trade at all. But let's just say that the market remains flat where it is now into it. I'm going to probably sell this 650 put going out to Friday, as I was saying, and use it to finance the one call that I need at the money for tomorrow, with the idea that I only need, so you can look at it this way, in that this is DTE 0 and this is going to be DTE 2. I only need the 0 to know what happens after the Fed. And if the market cracks hard on the Fed, then what I've done is I have then limited my profit to the downside, but I think that's okay because I'm limiting it all the way down at 650. So let's say we have a huge move down and the S&P goes down 15 points. I'm only going to make 10, right? Because I'm going to go 660 down to 650, and then my short put is going to kick in. And if we go down a lot and we stay down there into Friday, then my short position in the SPY is going to get called away at 650, and I will make the profit between 660 and 650. And that's basically it. So, you know, it's very hard to put on something that is neutral in cost where you can still make money if you are using the same expiry. But if you shift your expiries this way, where you're willing to have a short position further out in order to spend that money to protect yourself when you need it, which I believe that the only time I really need it is tomorrow at 2 p.m. Eastern, then you're fine. Then you can get down to a more neutral cost basis, and I believe it makes sense. So we'll see what this price is out for tomorrow, and I may have to make some adjustments here to get this to be equal, and it may not be perfectly equal, right? The hedge may cost whatever, you know, some $1,000 or something relatively small, but that's basically it. Okay, so that is how I'm going to manage the S&P going into tomorrow on the Fed, and we shall see what the reaction is going to be. All right, you guys have a wonderful evening. Hey, this is Peter from ShadowTrader.net, and I just wanted to thank you for watching this video. If you enjoyed this content, please hit the like and subscribe buttons, and if you'd like to trade live with me every day in my weekly options advisory, then check out the link in the description below. I wish you good trading, and I'll see you in the room.